What if I told you there's a financial instrument so powerful that its daily trading volume exceeds even the massive foreign exchange market? Welcome to the world of futures, the undisputed king of financial products that can make or break entire economies. Today, we're diving deep into everything you need to know about futures trading. We'll uncover what they really are beneath the surface, explore their mind-blowing characteristics, and reveal how a single trader once brought the Bank of England to its knees using nothing but futures contracts. By the end of this video, you'll understand the fundamental mechanics that drive trillions of dollars in daily trading volume and why futures are considered the most versatile financial instruments on the planet. Let's start with the basics. A futures contract is simply an agreement between two parties to trade a specific commodity at a predetermined price on a future date. Think of it like making a reservation. You're locking in today's terms for tomorrow's transaction. Here's how it works. Imagine I buy a gold futures contract for 100 ounces at $3,000 per ounce, expiring in December. This means I'm promising to buy 100 ounces of gold at $3,000 when December arrives. On the other side, someone else is promising to sell me that gold at the same price. Now here's where it gets interesting. If gold drops to $2,000 by December, I'm still obligated to pay $3,000, losing $1,000 per ounce. But if it rises to $5,000, I make $2,000 per ounce while my counterpart loses the same amount. But futures aren't just about buying and selling commodities. They're financial time machines that let you lock in future prices today, creating opportunities for both protection and profit. Futures originally emerged to solve real business problems. Picture a wheat farmer who needs to invest thousands in seeds, fertilizer, and land rent 6 months before harvest. He's terrified that wheat prices might crash before he can sell his crop. By selling wheat futures contracts, our farmer locks in his selling price today, transferring the price risk to someone else. Meanwhile, bakeries and breweries do the opposite. They buy wheat futures to lock in their purchasing costs. But here's where futures became revolutionary. You don't actually need to deliver physical commodities. Most traders close their positions before expiration, never touching a single grain of wheat or barrel of oil. This realization opened the floodgates. If you can bet on commodity prices without delivering commodities, why not bet on stock indices, interest rates, or even volatility? Suddenly, any measurable number could become a tradable asset. Let me show you futures' explosive potential with a real example. In early 2024, cocoa bean futures skyrocketed from $4,000 to $12,000, a staggering 200% increase in just months. The trigger? Reports of potential crop damage in major cocoa-producing regions like Côte d'Ivoire and Ghana. A fungal disease called black pod disease threatened to devastate cocoa trees across West Africa. Hedge funds spotted this opportunity and flooded the cocoa futures market with $8.7 billion in long positions. These weren't chocolate manufacturers, these were pure speculators betting on supply shortages. At the peak, hedge funds controlled over 85% of all long positions in cocoa futures. Their speculation didn't just follow price movements, it drove them, creating a feedback loop that tripled cocoa prices. This wasn't just paper profits. Chocolate giant Hershey actually hedged against rising cocoa costs using futures, generating over $500 million in commodity-related revenue in 2024. Quick question, what's the most heavily traded futures product in the world? Oil, gold, stock indices? The answer might surprise you. It's SOFR futures, contracts based on overnight US dollar interest rates. Never heard of them? That's because they're primarily used by massive institutional players managing interest rate risk. Every major financial institution faces interest rate risk. Whether you're managing loans, bonds, or even basic cash flows, interest rate changes can make or break your portfolio. SOFR futures are their primary defense. Next comes stock index futures, contracts tracking indices like the S&P 500 or NASDAQ 100. These allow investors to bet on entire markets rather than individual stocks, making them perfect for hedging broad market exposure. Then we have traditional commodity futures, oil, gold, wheat, soybeans. These remain crucial for producers and consumers needing to lock in prices months or years in advance. Futures offer incredible leverage. While buying $100 worth of stock requires $100, futures might let you control the same exposure for just $5. That's 20x leverage compared to traditional investing. Want to bet against something? Futures make it effortless. Going long or short is simply a matter of direction. No borrowing shares, no complex arrangements, just pure directional betting. Perhaps most importantly, futures trading is completely anonymous. While large stock purchases require disclosure, futures trades remain hidden. You see the price and volume, but never who's behind the orders. On September 26, 2024, someone placed a $118 billion SOFR futures trade, the largest single transaction ever recorded. Nobody knew who did it, sparking wild speculation across trading floors worldwide. Let me tell you the most legendary futures trade in history. In 1992, European countries used a system called ERM to peg their currencies to the German Deutsche Mark. Britain joined this system in 1990, tying the pound to European stability. But by 1991, problems emerged. The German economy was stronger than Britain's, and UK inflation was rising. This created an impossible choice: raise interest rates to defend the currency and hurt the economy, or stimulate the economy and let the currency fall. George Soros spotted this contradiction and prepared what he called the short of the century. His plan? Attack the pound using massive futures positions to force Britain out of the ERM system. Soros didn't just short pounds in the spot market, he amplified his attack through futures contracts. By shorting pound futures with 10x leverage, he could apply massive downward pressure while other speculators joined his assault. On September 16, 1992, Black Wednesday, the Bank of England burned through billions defending the pound. They raised interest rates from 10% to 12%, then to 15% in a single day. It was futile. By evening, Britain surrendered and exited the ERM. The pound crashed 15% against the Deutsche Mark and 25% against the dollar. Soros made approximately $1 billion from this single trade, while his fund gained $1.5 billion overall. Futures aren't just contracts. They're financial weapons that can hedge risk, amplify profits, or even topple central banks. Their combination of high leverage, easy short selling, and complete anonymity makes them uniquely powerful. From protecting farmers against price swings to enabling trillion-dollar institutional hedges, futures touch every corner of the global economy. Understanding them is understanding the hidden machinery of modern finance. This is just the beginning. The futures market contains even more sophisticated strategies and devastating crashes that have shaped financial history. If you want to see how futures have exploded bond markets, crashed oil prices, and created some of the most spectacular trading disasters ever recorded, make sure to subscribe and hit the notification bell. Because trust me, the stories I haven't told you yet will make Soros look like a small-time player. See you in the next episode where we dive into the dark side of futures trading.